Welcome to Richie Shot.
Gold is shining, the Fed is wobbling, and markets are searching for balance. Let's dive into the week's key story. Macro week ahead: CPI, ECB, Oracle, and more. Markets are bracing for a data-heavy week, with inflation in the spotlight and central banks back on the agenda. U.S. CPI, Thursday. Economists expect consumer prices to rise 2.9% in August, up from 2.7% in July. That slight uptick complicates the Fed's balancing act, a cooling labor market versus sticky inflation. With the FOMC meeting just days away and officials in their quiet period, traders are left guessing whether the Fed cuts now or later. Oracle earnings will offer another lens on the AI boom. Wall Street is watching backlog, seen near $150 billion, and free cash flow, expected $1.8 billion after last quarter's negative print. CEO Safra Catz has already lifted guidance, betting on strong demand for cloud-based AI infrastructure. Europe is no quieter. In France, Prime Minister François Bayrou faces a confidence vote over his fiscal plan. Failure could trigger his resignation, just as French bond yields climb to decade-plus highs. On Thursday, the ECB is widely expected to keep rates at 2%, though the hawk-dove split is sharpening. Finally, China's data is under the microscope. Exports slowed to 4.4% in August. Imports also weakened, and inflation prints later this week will be key for gauging global growth momentum. Gold near record highs. Gold is holding close to Friday's record of $3,600 an ounce, just $20 shy of its peak, as markets digest weaker than expected U.S. jobs data. The August payrolls report showed hiring slowed sharply, while unemployment climbed to its highest level since 2021. That combination was enough to turbocharge expectations of Fed rate cuts, with traders now pricing in as many as 3 reductions before year-end. Lower borrowing costs instantly make non-yielding assets like gold more attractive, and safe haven flows are gathering pace. On Friday, bullion spiked as much as 1.5% in late trading, a reminder of how quickly sentiment can shift when investors sense policy is tilting dovish. But it's not just about rates. Political risk is creeping into the equation. Trump's effort to oust Fed Governor Lisa Cook has raised fresh questions about the central bank's independence. If he succeeds and replaces her with a more dovish pick, gold's tailwind could grow even stronger. Goldman Sachs has gone as far as projecting that any erosion of Fed credibility could spark a wholesale reallocation. Even a small shift from treasuries into bullion could push prices toward $5,000. On the global stage, China is also reinforcing the narrative. The People's Bank of China boosted its gold reserves for the 10th straight month in August, a clear sign of its determination to diversify away from U.S. dollar dependence. Combined with Washington's move to exempt bullion from new metal tariffs, the policy backdrop is lining up in gold's favor. For now, investors are watching two fronts: economic data that could lock in the Fed's easing path, and political decisions in Washington that may redefine the central bank's role. Gold is sitting right at the intersection of both, a hedge not just against inflation, but against institutional uncertainty. Gold isn't just a metal anymore. It's becoming a barometer of politics, policy, and power. And with so many forces pushing in the same direction, this rally might be just getting started. Oil rebounds. OPEC Plus in focus. Oil prices kicked off the week on firmer ground, clawing back some of last week's sharp losses. Brent crude gained 1.2% to $66.30 a barrel, while U.S. benchmark WTI matched the move at $62.62. The bounce comes after both contracts slid more than 2% on Friday and lost over 3% across the week, as weak U.S. jobs data cast a shadow over demand expectations. This week, however, the narrative is shifting. Overnight strikes in Ukraine have reignited the debate over whether fresh sanctions could be imposed on Russian energy. Any additional restrictions would squeeze already fragile supply chains and put a floor under prices. That geopolitical premium is now colliding with OPEC Plus's latest production move. On Sunday, the producer alliance agreed to raise output again starting in October, but at a much slower pace than the aggressive hikes seen in recent months. 8 member countries will collectively add just 137,000 barrels per day, compared with 555,000 barrels in both August and September, and over 400,000 in the summer. The cutback in pace was unexpected, especially as the Northern Hemisphere heads into the high-demand winter season, where oversupply fears had started to creep in. The decision reflects a delicate balancing act. Saudi Arabia has been lobbying hard to claw back market share, pushing for higher production. But others in the group remain wary of tipping the market into a glut, especially with global growth still uncertain and demand signals uneven. The compromise suggests OPEC Plus is prepared to test the waters, adding supply, but keeping a lid on volumes to avoid another price collapse. What this all means for traders: oil is once again caught between 3 powerful forces: geopolitics, cartel strategy, and macroeconomic demand. With Russia's role under scrutiny, OPEC Plus managing expectations, and the Fed shaping the growth outlook, crude is unlikely to settle down anytime soon. Volatility looks set to remain the only constant. China's humanoid robot bet. CNBC reports the race to build household robots is heating up, and China is stepping up fast. On Monday, Shenzhen-based startup X Square Robot revealed it had raised about $100 million in a funding round led by Alibaba Cloud, bringing total investment to nearly $280 million in less than 2 years since launch. It's the company's 8th financing round since December 2023, an extraordinary pace that underscores how intense the competition has become. Heavyweight backers like Hongshan, formerly Sequoia China, Meituan, Legend Capital, and Eins Capital also participated. While X Square declined to disclose its valuation, the investor roster alone signals surging confidence in China's humanoid robot ambitions. The bet is clear. Venture capitalists are banking on the integration of humanoid robotics and generative AI to redefine how machines interact with people, shifting from basic task execution to adaptive, almost human-like engagement. The open question isn't just whether these robots can scale, but who will crack the code first. And with Alibaba now in the lead investor seat, China just turned up the heat on the global robotics race.